Welcome to the Lend Academy podcast, episode number 195. This is your host, Peter Renton, founder of Lend Academy and co-founder of the Lend It Fintech Conference. So welcome to a special Lend It Fintech edition of the Lend Academy podcast. We are here live at Lend It Fintech USA 2019, and I am joined by Jerry Nemorin from LendStreet. He is the CEO and co-founder of LendStreet. Welcome to the podcast, Jerry.
Thank you for having me.
Okay, so let's just get started. We've known each other now for many years. You're a bit of a veteran of the fintech space these days. But why don't you give us a little bit of
masochist?
Well, give us a little bit of background about yourself and sort of how the arc of your career has gone.
Sure. Well, personally, I'm originally from Haiti. I grew up in Haiti and moved to the States when I was very young, and studied at the University of Florida, studied finance at the University of Florida, and then did my MBA at University of Virginia, the newly minted national champions. And finance is something for me that was always a subject that I was really passionate about and interested in. And after the credit crisis, I was working at Bank of America Merrill Lynch in their leveraged finance financial sponsors group. And the idea for LendStreet, really stemmed from what the things we were doing on Wall Street, helping major businesses restructure their debt and getting them a path to being financially viable and sustainable. And as a very early lender on Prosper, I thought, the idea of creating a debt restructuring platform that not only, allowed the consumer to get a pathway to financial health, but also give the creditor a way to recover more capital, which didn't exist then. You and I had this conversation before, where we started off with Prosper and Lending Club focusing primarily on debt consolidation, but there were really no sophisticated debt restructuring platform that was focused on the consumers, that when they experience a financial shock, how do you help them rebuild? How do you help them get back on path? And that didn't exist at that time.
Right. So then, you started this company, and it was many years ago now, and you've stuck at it, which you really, many wouldn't, I don't think. But so tell us how it's gone, because we first met, I think it was like 2013 at a meetup here in San Francisco, and you've stuck at it. So tell us a little bit about those early days and how the journey has been.
Yeah, I think you're right. Many wouldn't have stuck through it, but for me, this is as personal as it is professional. Right. I think most entrepreneurs will tell you, you don't do it. You don't take the risk of being an entrepreneur for the sake of really hitting it big. As we know, the odds are against you, right? 9 out of 10 companies will fail.
Right.
But for me, this was a product that I believe really, truly needs to exist. It's easy for consumers when they're financially healthy. There's so many products out there that we're trying to give, and quite frankly, our industry have helped increase access, right? But we haven't had a product that actually think about the holistic health of the system, not just the consumer, but how are we impacting the financial system? Are we adding more risk? Are we making it safer? Are we helping reduce the cost of capital across broadly? So for me, this was a product that my family could have used back in the days, and so deeply believe that it needs to exist, and no matter what, I had to make sure that I gave myself a chance to see it through. And so starting off, it was really difficult. Imagine telling investors that you want to create a product that helps people in financial distress, who are delinquent, who are distressed, and you're going to give them a loan so they can pay off their debt. So it's just an oxymoron in many ways. And selling innovation is hard. Right, selling innovation to people who cannot empathize with the problem is even harder. And so, our journey was much harder than most. We had to prove a lot more to make sure that the thesis that we had, which is that consumers who are financially distressed, if you're able to right-size their debt, get them into a payment plan that makes sense, they will perform. And perform like they were prime. or near prime at that. And that was always the thesis, that if you can match the capacity with the intent, you can make it happen. And so it took us a bit to get off, because that was something that not most people would really, identify with. But we were able to show the data. It came down to the numbers.
Right.
So we were able to show the data, prove out that there was a group of clients. If you take the lens of consumers are inherently good, they want to make payments. Now, there's outliers.
Sure.
Right? There are outliers. But if you take the notion that people are inherently good and they want to make good on their debt, that when they experience a financial shock, it's a matter of bridging that capacity with the intent, that we could create a product that truly, make a significant impact in the lives of those individuals, but also create a product that helps creditors improve their recovery.
Right.
Right? And ideally, by improving the recovery for creditors, you ultimately make the system safer and you make the system less costly. Mm-hmm. And that's been, sort of the focus with LendStreet, and that's what we've been striving to do.
Right. So the early days, I want to go back. I know we talked about this a while ago, a couple of years ago, I think. But when you were talking about that early days and you first raised money and you loaned that money out, and you basically, I remember you said at the time, you said, if I'm proven wrong and this doesn't work, then I close up shop and go home. But so you lent out that first cohort. So tell us a little bit about that and how they performed.
Yeah, so we raised capital, really friends and family, and just to prove out that at the end of the day, the thesis was that they would repay if they didn't pay within a structure that was market based, right? Not just did they repay, but for me it had to be market based solution. So for the price, for the risk that that we were taking, that we were recovering a certain amount of capital and a profit, that would make sense to attract additional capital to scale. Because I don't think you can do real social impact without scale, without market-based solutions.
Sure.
And so the first cohort we did performed incredibly well. We actually surprised ourselves. We had less than 5% default on that first cohort. Mm-hmm. It at scale certainly didn't hold up that way, but it was a metric. The thing that we were measuring is, if we're able to lend to those consumers, will they repay? And that was a question we've got consistently, through the process. Will they repay? Will they repay their debt? And our belief was that these are consumers, we call them recovering prime. Right? So these are consumers who've historically been good credit, experience a financial shock, and they've proven in the past their ability and willingness to pay. It's a matter of, in this moment, they can no longer make those same level of payments. And so if we can restructure that debt and restructure the payment to what they can actually afford, will they repay? And that was the big thesis. That was the, I'd like to believe it's the $1 billion thesis that I had, but time will
maybe
tell.
one day.
Maybe one day, right? But that thesis did play out. And it played out where, we had the default rates that we had were controlled enough, were low enough that we could create a product that could be, that could be scaled,
right,
and could attract, capital, given the rate of return and so forth.
Yeah, so you've got sort of mid-single-digit default rates, but with to a population that looks at first glance like they're deep subprime or definitely subprime, right? Yeah,
that's exactly right.
Yeah, so then maybe I want to sort of talk a little bit about how your product works, but before we get to that, maybe you could explain a little bit about the debt settlement industry, and there's certainly. It hasn't got a great reputation in some areas. Some of it's, I think, earned that reputation. But obviously there's good and bad players. But tell us a little bit about your approach to the debt settlement space. Yeah,
so prior to starting LendStreet, I didn't have a consumer background, nor did I have a debt settlement background. Mm-hmm. So, the concept for LendStreet was based on a project that I worked on in banking, where in 2008, 2009, world was coming to an end and market was crashing. And we covered private equity owned companies. Mm-hmm. So naturally they are heavily indebted. And so one of the companies we covered came to us and said, hey, we'd like to figure out how do we take advantage of this market dislocation? We believe in our ability to be sustainable, to be viable going forward. But we think the market is, in a different place, and we'd like to take advantage of it. And so the MD that I worked with at the time said, look, why don't you get capital from your private equity sponsor, take that capital, buy back your own debt, and effectively delever the company significantly. I think we delevered it by a turn or a turn and a half. Mm-hmm. And so what that did for that company was that it lowered their debt, it lowered their interest servicing. Right. So it created cash flow for that company, made it more viable, more sustainable, and by the way, it created equity, right? Equity value for the private equity. So it was a win-win-win, right. idea. And I watched that and I said, well, if we can do that for major businesses, and as a lender on Prosper at the time, I was lending $25 at a pop on Prosper. I might be one of the few people who didn't lose money, didn't make any money, but I didn't lose any money. This was 2008. And, I thought, if you look at the loans that were being originated on Prosper, a lot of it was to consumers who were looking for debt consolidation and who were 560, 580 at the time.
Right.
I think 80% of the loans were 580 at that time. And so I thought, if we could create a product similar to what we just did for this major business, which is a debt restructuring platform that focuses on helping consumers who have these delinquent debt, help them negotiate it with their creditors, give them the loan to pay off that debt. So the creditor at this point is able to recover more capital. The consumer gets a new loan that can help them rebuild their credit. And our investors get a rate of return that is market, that makes sense for the risk that they're taking. And so that was sort of the aha moment. This can be a win-win-win business model.
Right.
And so started doing research into what is out there. Does this exist? Who else is out there doing it? And what are the options that are available to consumers when they face these financial difficulties? And so during my research, I read about credit counseling, I read about debt settlement, and I read about bankruptcy. And this was 2008. So prior to 2008, debt settlement was able to get paid their fee even when they hadn't delivered the service. And so naturally you have an industry that attracts a lot of people who necessarily didn't have the best intentions in terms of serving the customer, right? And so debt settlement had a really, really bad, if you look back, 2007, 2006, 2005 research on debt settlement, it had a really, really bad reputation. There are some reputable folks doing it, but like any other industry, it only takes one to spoil it.
Right.
And so I thought, debt settlement is a needed product. Let's be honest. Consumers face financial difficulties. They need a solution that helps them get back on path. And debt settlement allows them to do that without having to do the legal bankruptcy process.
Right.
Unfortunately, though, it didn't have the scrupulous actors that was necessary to make this a significant industry and a significant business. So what does debt settlement do? So the typical debt settlement, in the past, they used to get their fees up front, so they didn't have an incentive to deliver the service. In 2008, the FTC passed a new regulation that they can only get paid when they deliver the service now. And so the way the debt settlement model works is that consumers will enroll, they'll start making payments into a savings account so that they can eventually settle their debt. On average, it's about $25,000 to $30,000 of unsecured debt across 6 creditors. And so they're making these monthly payments into these savings accounts so that they can save enough to eventually settle in one at a time.
Right.
And so I thought, here you have a consumer who's demonstrated a willingness, because they could have easily just walked away from this debt, but demonstrated a willingness to pay. And by the way, you have also demonstrated the capacity to pay, because they're making these monthly payments into these savings accounts. And I thought, if we want to solve this debt settlement issue, which is a lack of trust amongst the creditors, a lack of trust for consumers because the service wasn't necessarily being delivered, and certainly a lack of trust amongst regulators, the only way you do that is to create a product that actually is a win-win-win value proposition across the board. Right. And so that gave rise to LendStreet.
Right. So then maybe just talk us through an example of one of your customer you have. I mean, is it credit card debt they're doing? Is it personal loan debt, or is it a combo? And then tell us about that, and then how the process works with you guys.
Yeah, so it's typically a combination. Our average consumer will come in with about $30,000 of debt, 25 to 30,000. It's across multiple credit cards and some unsecured installment. Mm-hmm. And the way the process will work is we partner with settlement companies.
Right.
The customer would have been in their program. They've already made several payments. They'll reach out to the customer and say, "Hey, you've been in our program. Rather than make these monthly payments over 48 months and still getting collection calls and potentially lawsuit threats, because you've demonstrated the ability and willingness to pay, we can potentially get you a loan to pay off your debt, to negotiate and to do all of them at once." And so the customer then says, "Sure, you mean I can go from being in this program for 48 months, getting collection calls, lawsuit threats, and so forth, to now getting a consolidation loan that is less than what I originally owed, but at an interest rate, our interest rates are 14.95 to 18.95, at an interest rate that is not I think it's reflective of who they are, but it's not reflective of the credit score because it's less than the credit rate.
They're
at 566 FICO, they're in the subprime lane, so they would expect 22 to 30% interest rate, right? So we're pricing them where we believe they are as an individual, not where they are as a credit score person, right? So that's the loan product. So the consumer submits an application, we underwrite them, we approve them. The settlement companies go out and do the negotiation. We fund the settlement, and the customer now has one loan. All of their accounts are settled. All of the the delinquent ones are settled, and we pay it off. And they're making one payment to us, and we report to the bureaus, so it helps them rebuild their credit, and so forth.
So when they come to you, has the debt been already negotiated?
No,
been negotiated.
It's delinquent at the time. It's delinquent. It's not negotiated yet, so we have to do an estimation of what that settlement will be, and we're providing them a line of credit that allows them to go out and do the negotiation and draw on it and fund.
Right. Okay. So one of the knocks that you hear in the industry is that some of the platforms, the lending clubs and Prospers and Narlets or whatever, they don't want their debt to be settled. They want their debt to be paid in full. They don't want it to be settled down. So what are your conversations like when you talk to those organizations like that? How does that go? And what do you tell them?
I'm no different. I want my debt to be paid down, right? So because we're lending, right? So for me, we're taking risk in lending to this consumer. So similarly, we make sure we're looking for consumers that truly had a hardship. And what I think the industry, we've had these conversations amongst folks in the industry, is I'm not here to help anyone defraud the creditors.
Right.
I don't believe that's the right solution. I believe, if in our average DTI, right, when you look at our customers, talk about customers who have 75% DTI, right? These are consumers, they can't live on that.
Right.
There's no question about it. They can't, it's not sustainable, right? And so, the way, obviously, whenever you lend, you're going to have delinquencies, you're going to have defaults. And unfortunately, what we've seen in the past, and I'm not saying that they don't have good reasons to be mad about, the settlement companies and things like that. But I think there's a belief that, debt settlement companies were particularly targeting their customers. I don't know if that's the case. I think what happened is customers who are going into consolidation loans were really trying to outrun a situation.
Right.
And the problem is that trying to outrun a situation did not necessarily resolve that situation.
No, it just delays it.
It just delays it.
Right.
And that's what you're seeing, is that these consumers, with 50, 60, 75 DTI, they get a loan. Either they pay off that original credit card or they don't, right? But even if they pay it off, they now have access to this credit card where they go back and swipe.
Right.
And unfortunately, for majority, our customers are middle income, right? So these aren't high earners or anything of that nature. And so I do agree with the industry that there has to be a come upon agreement that says these are the parameters. If the consumer looks like this, then they're and they come to you, let's figure out a way to work to make sure that this customer gets back on path. Right. And vice versa. I think for settlement companies, it's if this customer looks like this, we're not going to service them because, they have the means, they have the ability to pay.
Right.
They don't need our service, right? And I think that's where both industries need to acknowledge the need, for each other and the need to balance, right, the service that each one of them provide, such that it's a healthy and viable ecosystem.
Right. No, that makes sense. So maybe you could tell us a little bit about what happens when your customers come into your program, and they, I presume, they continue to make payments on the loan. What happens to their credit score?
Yeah, so what we're seeing now is that consumers who've been in our program, typically the credit scores improve by 80 points within 12 months and over 100 points within 18 months. And that's largely, my belief is that that's largely due to the fact that we're able to clean up their credit, right? So first and foremost, they no longer have the delinquencies showing up in their credit report. Secondly, they have a lower amount of debt. We've been able to restructure their debt such that their DTI is now, below the 70s. It's now closer to a 45, 50%. Right. And so we've made them better customers, better credit profile. Mm-hmm. And that's what's allowed them to become, and they're making monthly payments, and those payments are being reported back to the bureaus, which we know is a key component of credit scores. So, I think that's why we see the benefit. And then one anecdotal thing too is what we're seeing is these are consumers, again, on average 50 plus years old. And so they, a good chunk of them have homes. And so they'll go out and refi their homes, take capital, pay off our loan. And for us, that's an exciting moment. Because we're able to take this customer who was in a point of financial distress, help them rebuild their credit, and now they're making savvy, financial decisions to improve their financial health long term.
So you mentioned your pricing. It's like you said, like 14.95 to
18.95.
18.95. So how do you decide who gets what price? Is there a risk-based pricing component to this or not?
There isn't. We're a flat fee. Right. We're state by state, so some of that is driven by state regulation. So, we have to be mindful of APR caps in certain states, origination caps in certain states, and so forth. Okay, so then basically someone comes into your program, it's a binary decision. They either get the loan or they don't. Right. That's exactly
right. Okay, that makes sense. So then, what is your revenue model then? Are you taking an origination fee? Are you taking a fee on the back end? How do you get paid?
Yeah, it's a combination. We get a portion of the debt settlement fee for helping accelerate their revenue.
Okay.
Right, because normally they would have monetized that customer over 36, 48, 60 months.
Right.
Right, and we're helping accelerate that to 6 to 9 months. So. In some ways, if you think about it, it's almost factoring their fees.
Right.
And we're taking the dropout, delinquency, default rate, default risk.
Well, you're taking on the risk, yeah.
We're taking the default risk. So,
yeah.
They give us a portion of their fee as a result for providing that service. We get an origination fee for the consumer, and on loans that are on our balance sheet, we get a sliver of the interest spread. And those that we sell, we get a sliver of servicing fee.
Right. Okay. Then, so can you give us a sense of the scale you're at today? Is there what sort of how many loans are you doing?
Well, first, I think this is an industry where you're talking about there's 71 million consumers,
right,
and $680 billion of distressed debt in the U.S. So what we've done is not even remotely close to scale. I wouldn't even call scale. Right? I don't even think about. We haven't even had a pin drop in this problem, right?
Yeah.
Because when we think about it, right, the thing that I'm most proud of, right, is our entry into the space have created multiple new companies that are doing similar things to us. Mm-hmm. And so while unfortunately, we have more competitors than we would like, but that's business. whenever there's a good product, good service, a need for it, there's going to be competitors. But we're excited about the fact that what we've seen is settlement entities have grown. Right? The debt settlement space itself has grown significantly. We're starting to see delinquencies rise in the credit card space. So we know that means there's going to be a significant amount of defaults and delinquencies. So we've been building ourselves for scale, for true scale. I think what we've done today has been great, and we've made an impact, but we're not even close to what I would call real scale yet.
Right. So I know you raised a Series A last year and also significant debt capital from really some of the marquee names in the financial health space. So tell us a little bit about who's backing you and about that process.
Yeah, our mission is to deliver financial health, and our vision is to create a just financial system. So we want to be the catalyst. We want to be the way I think about it is we want to be the lab that creates the solutions that help consumers get access to products where it was previously inaccessible. We want to create solutions that help consumers improve their financial health, get them back on path. We want to be in a way the think tank, right, where we can come up with the better solutions. Where there's non-transparency, we want to improve transparency. Where there's predatory pricing, we want to eliminate the predatory pricing, or not eliminate, but at least create a better product that gives the consumer a different choice. And so as a result, we've been able to attract some of the more mission aligned, but also mindful of the need for a market-based solution to attack these problems. So we have Prudential as one of our investors. We have the Radical Impact, Candide, which is a combination of some of the Pritzker family funding. We've got CFSI, which is a big backer of ours, and we're part of the JP Morgan Chase CFSI Fin Lab. And so, so we've been fortunate enough that people who are recognizing that what we're doing is adding significant value, not only for the consumers, but also creating real value economically. That this is a viable business, and that deserves to be funded and given a path to scale. Right.
So we're almost out of time, but maybe just a couple more questions before you go.
Sure.
So, are you open to outside investors, or are you just using your funding line that you've got? Or
yeah, we're using what we have, but we're in the business of renting money, right? Unfortunately, you're always raising when you're in our business, so you're always talking to more folks. You're always creating a pipeline. You're always making sure what's out there, what the pricing is, and what are the opportunities going forward. I mean, it wouldn't be prudent of me to not have those conversations and always be talking to various investors, because as we scale, right, we need more access to more capital, because that is effectively our product.
Right. Okay, so then give us a sort of a look down the road. Where are you hoping to go, 12 months, 24 months down the road? What are you hoping the future holds for LendStreet?
12 months, I'm hoping we do several things. One is that we finally get the lenders to recognize the need for such a product, and the ability for our product to provide a quicker recovery, a much better recovery than the typical process, which is charge off the debt, package it together, and sell it off. So ideally, we get a few major creditors to be partners, such that we can help restructure the consumers who are currently in a delinquency mode. So that's one piece. On the consumer side, while we created a product that's incredibly consumer friendly, we haven't done nearly enough to create the engagement that we want and to create the impact that we want, which is ultimately being able to take the consumer from a point of financial distress and giving them a path to being financially secure and not ever be needing our solution. So we need to do a whole lot more work in that area where, to create better engagement, better tools, better solutions for the consumer. And then lastly, I think, what we've been doing for the last few years have been building for scale. And so now to actually go out and scale this business in the way that we know we can, and knowing the needs that's out there.
Right. Okay, well, on that note, we'll have to leave it there. Thank you very much, Jerry. It was great to have you on the show.
Likewise. Thank
Thank
you,
you.
Peter.
Okay.
Thanks for having me.
Thank you.
Are you open for questions?
Sure. You know, ask
Anybody
questions.
would like
Anyone
to
wants
ask a question?
questions? No?
Just raise your hand, please.
Jerry, congrats on building a fantastic business. You're clearly doing good for consumers, so congratulations. But you're in the industry, obviously, that's kind of had somewhat of a sullied reputation. You're one of the sort of shining stars there. Talk to us a little bit about sort of your strategy or techniques or ways that you envision down the road helping giving buoyancy to the industry and maybe engaging the regulators to bring to light some of the positives that you're doing so people can see exactly the model that you have is really designed to help consumers and do some good in the industry.
Yeah, absolutely. So the question is, obviously we've built something that's been impactful, but how do you both engage regulators to make sure that they understand what you've built and how it's impacting the consumers, as well as building a broader brand amongst consumers or people in the industry to understand our business, understand what we're doing. I think it comes down to one thing, and first and foremost, just creating a product that actually delivers a service at a price point that makes sense. And that's been our focus, is first and foremost, our product has to be good. And we've done that. And it's consumer friendly, it's consumer, and at the heart of what we've done and everything we're doing is the consumer. And that's all we think about, is how does this impact the consumer? How does it impact their cash flow? How does it make sure that they're actually getting better? And so I think because that's been part of our DNA from day one, it's allowed us to have many conversations with the CFPB. It's allowed us to have conversations amongst the regulators, and we're open book, right? Because we're very much aligned with their vision of a better financial system that service the broader population. And so we've been able to have those conversations and continue to have those conversations. And so but really to your point, we have to do a better job as an organization to start tooting our own horn a little bit. We don't do that as well. And really to get our story out there and let people know what we're doing and how we're doing it and the impact we're having on consumers.
Okay. Thank you very much. Thanks again, Jerry.
Thank you. Thanks,
Okay.
Peter.
Thank you.
See ya.